Welcome to Business Exit Success, the podcast dedicated to helping small business owners on how they can successfully transition out of their business on their terms while also living a life of purpose and fulfillment after the sale. I am your host, certified financial planner and certified exit planning advisor, Tom Poltersdorf. One of the most important things to have in place as a business owner and entrepreneur is a disciplined approach to investing. And not just with your investment portfolio or 401k, this is with investing in anything like private equity or real estate. To have a disciplined approach, in my experience, will help you know what your target allocation should be that's in line with your risk tolerance and goals. Having a target allocation will help you make better investment decisions when new and exciting random opportunities come up and you are able to avoid making unnecessary investments. And here's what I mean by that. Let's say you're talking with a buddy of yours and they say, "Have you seen what Bitcoin is doing? Maybe we should consider getting some of that." Or, "Did you see this startup, these investment properties? They're going to be worth millions in a few years." And because the opportunity is exciting and attractive, you may go ahead and buy into these things. What happens is you end up taking unnecessary risk with your wealth because you become overweight in that one category, even though it may be exciting. Let's say someone approaches you with a private equity deal and you already have 10% of your wealth allocation in private equity. Well, now you know to turn down the deal because you don't want to be overweighted in that area. But you wouldn't know to turn down the deal if you didn't have a target allocation set up for yourself. And that starts with understanding where is your money right now and how is it allocated. If you make a list of all your assets, most of your net worth will be in your business, and maybe you have a 401k, a SEP IRA, and some real estate. Once you understand where your money is today, then you create the target allocation. Now let's talk about what's in a target allocation. This will include U.S. stocks, foreign stocks, bonds, cash, and sometimes alternative investments like private equity, private real estate, hedge funds, crypto, etc. Now, my preference as a certified financial planner and someone who works with business owners, I encourage keeping the allocation simple rather than complex for two reasons. First, even though crypto and hedge funds are exciting, they add additional risk to your wealth allocation that may not make sense. In some cases, it can make sense and represent a very small percentage of your overall wealth allocation. Remember, your private business that you are trying to grow is already super high risk. Staying diversified outside of your business and managing risk effectively will allow you to stay wealthy over a long period of time, especially when you go through periods of fluctuations in your business. Having assets that are outside and separate from your company can help when there are liquidity needs. Second reason to keep your outside money invested in a simple manner is based on history and investing in probabilities, not possibilities. Here's an example. In a study done by JP Morgan, if you took a 50% stock and 50% bond portfolio invested from 1950 to 2022, your average annual return would be 8.7%. Now, there is no guarantee that will happen again over the next 20, 30 years, but based on prior market cycles over history, there is a high probability that the portfolio will be higher than it is today over time. Now, investing based on possibilities is where you can make mistakes or miss out on opportunities. An example, I had clients who wanted to stay completely in cash because they were 100% sure the market was going to crash and not come back for another 10 years. I heard this because of elections taking place, the supply chain issues because of COVID, inflation skyrocketing. Insert whatever you want in there. I've heard it. And when you wait and try to time the market like this because you think something possibly could happen, you miss out on opportunities. So invest based on probability, not possibilities. Keep in mind, building out your allocation can take time, but taking a hard look at where you are today and comparing that to where you want to be in your target allocation, you can create a roadmap to get you there over time. Remember, business owners get wealthy by being concentrated in their business, but stay wealthy by being diversified outside of the business. Hey everybody, real quick before you take off, if you found this episode helpful in any way, please rate the podcast and leave a review. I would love to get your feedback and see if there are any topics you'd like to hear more about going forward. Thank you, and I appreciate you all very much.